Our next panel coming up is on the future of mortgage finance. And we're very excited to have our moderator today, Nick Timmeros, who is a very respected journalist at the Wall Street Journal, writing on housing, mortgages, and finance. And Nick is going to kick off the panel. Thanks, Nick.
Thank you, Amy. Good morning, everybody. Mic on? There we go. Good morning, everybody. I'm really looking forward to this panel. So this morning I'm joined by, from the left, Mike Fratantoni, Vice President for Research at the Mortgage Bankers Association, Jason Gold, a Director and Senior Fellow at the Progressive Policy Institute, Lori Goodman, Senior Managing Director at Amherst Securities, Chris Mayer, Professor of Real Estate at Columbia Business School, and Scott Simon, Managing Director at PIMCO. So to start us off, I'll ask Lori, who is always armed with great data and analytics. When we look at what is happening in kind of housing finance reform, I think we can kind of break it into the near term, the transition steps, and then the long-term stuff. And hopefully we'll get into both today. But to start us off on some of the short-term steps that the FHFA is taking to bring back private capital, I wonder, Lori, if you can walk us through what it is the FHFA is trying to do, because Ed DeMarco is kind of on his own out there, that Congress and the administration aren't doing very much right now. So what is it that the FHFA is trying to do, and how successful are some of these efforts to bring private capital back? How successful are some of these early initiatives?
The FHFA is trying to do two things to bring private capital back. The first is that they're raising G fees fairly considerably, and the second is that they're trying to introduce risk sharing. And they have not yet done a risk sharing deal, although one is very, very close. In terms of raising G fees, guarantee fees have gone up around 24 basis points over the past year, from 28 basis points late in 2011 to 52 basis points late in 2012. This number includes their loan level pricing adjustments. Without them, the fees are perhaps 40 to 45 basis points on pristine products. So let's think about a 760 FICO, 70 LTV mortgage. This type of mortgage is going to have less than 5 basis points a year of losses, and they're getting a 25 basis point, they're getting like a 40 to 45 basis point G fee. Some of this more pristine paper, it's actually more economic for banks to hold on balance sheet. And despite some of the conversation in the last panel about interest rates being relatively low, well, they are, but banks don't have terrific loan demand. And you actually are, as a result of the increase in G fees, seeing banks begin to hold more of this product on their own on the books of their own institution. So when you look at actually what's happened to bank portfolio holdings, it went from 37% in 2001 all the way down to 10% in 2011. It was up to 14% in 2012, with most of it being backloaded to the second half of the year, in which the G fees were substantially higher than in the first half of the year. So you actually are seeing banks hold more of this product on their own portfolio, although it's important to realize that what they're holding is the best quality loans, because the loan level pricing adjustments don't quite compensate for the differences in credit risk on the lower quality collateral. So that part of the FHFA's initiative has been very, very productive so far, and we figure it will continue to be so. The second major action that the FHFA is taking is risk sharing. That is capital markets execution to get some of the existing or future risk off of Fannie and Freddie's books. The FHFA has mandated $30 billion notional amount of risk taking in 2013. There are two structures that conceivably work for this. The first is a senior subordinated structure. And if you do a senior subordinated structure, your senior bond is not TBA deliverable. So this tends to work best for non-TBA deliverable collateral, ARMs, jumbo conforming product, etc. The second is credit-linked note structures, where essentially your TBA pass-through continues intact, and you synthetically reference the losses on that pass-through for a note that covers the subordinated risk. Freddie, a couple of weeks ago, released credit data covering 15.3 million loans, or 53% of their book of business. And this was actually meant to be the data release for the first risk-sharing deal. So this suggested that it would be more generic collateral that would be used for the first deal, because again, that was the data that was released, and hence its credit-linked note structure. The fact that the data stopped when the loan was 6 months delinquent suggested the credit event would be defined as the mortgage has to be a certain number of months delinquent, and then the investor pays, and that certain number of months delinquent is going to be 6 or less, because that's where they provided data, and also that a preset severity would be used. So we actually believe they're very, very close with their first transaction, and it'll be very interesting to see how that goes.
So risk sharing is one of the primary ways in which we're testing the willingness of private capital to come back. And do you think, Chris, that is going to be an effective way of kind of restarting what has been the dormant private mortgage market?
I mean, I think certainly what Lori's described will bring capital back. I mean, capital, there's some price for everything, and the question is, at that price, will people come in and do it? The things that concern me about the process are really twofold. The first is the kind of blanket pricing encouraging banks to sort of pull out the best collateral for themselves and move the next into the government. Sort of average pricing has a long history in mortgages. It's not very good history. The related part about kind of selling off risk, the history that Fannie and Freddie have, anybody who are sort of mortgage traders in the room, we have at least one very good one to my left. Historically, Fannie and Freddie have used unobservable stuff when they put things into the market. So for example, they'd hold on balance sheet loans with a relatively low propensity to prepay, and they'd sell off loans that have a higher propensity to prepay. So the sort of issue where you're kind of selecting stuff to sell in the market, Fannie and Freddie have historically, with their balance sheet, sort of made money, so to speak, by doing that. So one of the big things I'm concerned about is kind of the selection bias in how all of this is going, what gets held by banks, what gets held and sold off. And the last concern I guess I have, it's going to bring private capital in, but you know, one of the big lessons from the crisis, I think, is that it's one thing to sell off risk. We know people will buy it at any, at various prices. It's much better when they control the risk that you're selling off. And so whether you look at CDOs, whether you look at credit card securitizations, just a whole set of securitizations, it's very, very different to sell risk you don't control with risk you do. And so I'm not a big fan of the approach of just selling off risk relative to selling off the risk in the process where people control both what's coming in and also the servicing on the other side, because I think controlling the servicing with contracts has not been the best approach to kind of managing all of this. So I think it will get private capital back, but I'm not sure that it responds to very many of the lessons that we've learned both about the GSE's history and about the crisis in general.
Scott, you have any thoughts on this?
Yeah, I don't think it helps much. It depends what you call private capital. Sure, so if you do $1 trillion of loans and you sell a risk piece on $50 billion, it sounds like a lot of money, but the real problem is the $950 billion that's left over. And that doesn't get done without a government guarantee. It also doesn't help in general private capital normal borrowers. I mean, if you want to get a adjustable rate mortgage, 790 FICO, 40% down loan, you can get one. But if you're a normal person, this doesn't help you even slightly. The G fees going up just makes Fannie, I told Eric Belsky last year, I used the word obscene, that they were going to make obscene amounts of money, Fannie and Freddie, going forward. The latest earnings thing said that. I mean, the book of business they've done the last 4 years is just unbelievable. How do you get money back into this market? How do you get people lending again? People give Wells Fargo crap because they make $450 billion of unbelievably pristine loans. Well, why wouldn't they? Citi and B of A stopped making loans. They used to be over 40% market share between them. They're down below 8%. They made terrible loans and got destroyed. Now they won't make pristine loans. you've lost 45% of the capacity in the industry. That's why loans aren't available, because nobody has to make loans. Wells Fargo is not going to make crappy loans when they can make pristine loans, period.
So Mike, I might ask, Washington has two stated goals right now. One is to make credit more available, and one is to bring private capital back. Are those two at odds with each other?
No, I don't think so. I'm going to kind of weave in some points from your other questions as well. I think Director DeMarco has done a fair amount to try to move the ball forward, particularly in the areas of standardization. Right? So we've got a servicing alignment initiative going on right now, a uniform mortgage data program. So now if you're a lender delivering loans to either GSE, you deliver the same data set with the same 200 data points defined the same way using MISMO data standards. That would seem like an easy thing to do, but that's going to save the industry, millions and millions of dollars over the years, because you've now uniform terms and uniform language to use across the industry. You have the steps toward a central securitization platform, and still some uncertainty about exactly what that's going to be. But if you can take the two existing infrastructures, meld them together into one that's better, that's going to perform better for the market as a whole, moving towards more efficiency. On the pricing point, we're still living in this somewhat Orwellian world where Fannie and Freddie are charging an adverse market delivery fee. So that's 25 basis points on every loan delivered to them. We haven't been in an adverse market for quite a few years now, if you looked at Stan's numbers at the beginning of the session. So kind of strange the way they're talking about it. And then exactly to Scott's point, if you're charging guarantee fees that are 2.5 times higher, what they were a few years ago, and taking less risk, that's a heck of a business to be in. And so it's a pretty easy way to make record profits the way they did in 2012. That gets to the risk-sharing piece, which is, yes, one way to draw private capital in is to make it so expensive and uncomfortable to deliver loans to the GSEs that they're looking for any other option, right? That's a way to trim around the margins. And as Lori said, some banks are saying, forget it. I'll take that risk of my own. I don't need to securitize. The liquidity is valuable. It's not that valuable, particularly with Basel risk weights coming down on lower LTV loans. But that's really just going to trim around the edges. You're starting to see, this year so far, non-agency MBS issuance is about as much as we had all of last year. You're starting to see some additional issuers enter the playing field. That's a real benefit, but it's just going to be around the edges. This risk-sharing idea needs to be expanded, because that's going to say, okay, it's not that you're just going to increase revenues going to Fannie and Freddie. You're going to start saying, I'm going to give you a trade-off lender. If you provide me a solution to take away some of that risk, I'm going to provide you a lower guarantee fee, right? Without that trade-off, risk-sharing doesn't work. The way risk-sharing is being talked about today, it's just a back-end transaction that Fannie and Freddie are handling. And from my understanding, they're saying no, right? They kind of like earning record profits. It's a pretty good situation to be in right now. They see that as an advantage going forward. So I think Director DeMarco's approach of just saying, okay, in 2013, you're going to do $30 billion in risk sharing, and it's going to be meaningful amounts of risk that's being laid off. So I actually see a whole lot swirling around here right now to each of your questions.
The last panel touched on, it seemed like there was a consensus there that credit is too tight, that it's too hard to get a loan right now. Does anybody up here disagree with that view?
I mean, it depends on what exactly you're looking for. I mean, I think in some ways right now we're kind of like at the optimum stage of where we would be in Fannie and Freddie, and FHA are kind of filling that role, obviously. If you want to expand beyond that, I mean, we just went through a time where the president talked about just expanding the box a little bit, and you'd think people, by some responses, you'd think people were talking about going back to the subprime days of no income, no asset, and he was just talking about getting outside of this pristine box. And that's kind of when we talk about private capital coming back. I'm not sure that we really kind of are always talking about the same thing. I mean, there's different types of private capital. There's the MIs that are going to step up a little bit more, and they filled a role here with the GSEs. They're going to step up a little bit more as FHA pulls back a little bit. There's the securitization investors. There's portfolio lenders, and they all have different paths to come back to the market. But I think when most people talk about the private capital coming back, I think there's the essential disconnect of this entire conversation, which is the private lenders want to lend is not the same thing as what the mass of borrowers want to borrow. And that's what Scott kind of touched on. And until we figure out how we're going to start and fill this giant box, which Fannie and Freddie and FHA are doing now, if you want to talk about the, getting outside of that, I mean, look, Fannie, Freddie, and FHA have a bigger box than what's being lent through the banks right now. Okay, it's the banks that are not lending that full box, right? So if we're talking about just getting outside of there, and they want a little more risk, and they want to charge for that, that's there. I mean, the difference between a 760 and a 750 borrower FICO score, you're telling me that for 10 bips, that's not worth the risk that they're going to default, and then we get into they talk about the putback risk. Well, if I don't dot an I, they're going to give it back to me. Well, I seriously doubt that Fannie's going to be asking for these loans that are making so much money because an I is not dotted. And they're talking about how these are low default rates, and they're written properly. QM and QRM are kind of written around this. So I kind of think that we need to look at where we are now. And when we talk about when the conversation about private capital, what I think it is that lenders want to lend arms to the borrowers who are borrowing the fixed rates, the pristine borrowers right now, and that's where I think we need to start the conversation and start working backwards.
So if we all agree that maybe it's harder to get a loan than it should be, what are the causes of that, Scott? What are some of the drivers? Jason mentioned credit overlays because of putback risk.
Well, I think it's even more fundamental than that. People talk about capacity utilization in factories. This is how I think about the mortgage industry, and the mortgage industry is running really close to capacity. When the mortgage industry is really close to capacity, so it's like you're a restaurant. You have 100 people waiting out the door. You don't lower prices, right? I mean, they don't need to. And the real problem has been that B of A and Citi don't lend, and it's actually very hard to start lenders from scratch at this point. You have regulatory uncertainty. You think instead of the industry making $1.5 trillion of loans a year, what if they only make $200 billion a few years from now? Regulatory uncertainty, so people aren't getting in. But the two natural biggest gaps are B of A and Citi. I mean, it is a joke the amount of capacity they have. They made terrible loans for years. Both institutions got blown out of the water, and they were picking up pennies in front of steamrollers and got their heads rolled over. Now they're standing in a field in Iowa. They can see 30 miles in every direction, and there's $1,000 bills lying everywhere. And they're like, oh, well, we won't do that this time. It's just a joke.
Right.
By the way, those two of the four biggest banks don't lend, basically.
Yeah.
So
Slight exaggeration.
This came up a little bit in the last panel, but so how much of this fixes itself when rates go up? I mean, if rates rise and the refi wave is over and people have to compete for business.
Well, I think the credit box expands if rates go up, which is sort of exactly the opposite of what you'd think would happen. But people are going to want to lend, and they're going to go.
Yeah, but is it the Fannie box that expands, or is it portfolio box that expands?
Well, no, but the Fannie, Freddie, Ginnie boxes are just what they are. So Ginnie can make 500 FICO loans if they want, but all the big lenders will not hard floor at 640. You reduce their capacity. They have so much need to make money out of their mortgage companies. They're going to go, well, what the hell? A 730 mortgage is great too.
Hey, Nick, can I put some numbers around this? Because I think I want to make sure this is a data-driven conversation. I'm an economist. I have my favorite data set, right? So you go back in 2002, you look at the typical number of applications a mortgage underwriter looked at. It was around 190, right? And that number we benchmarked, true for small lenders, true for large lenders. Today it's about 50, right? Well, why is an underwriter looking at 1/3 fewer applications per month today? Because, Jason, I'm going to disagree with you here, they can't be wrong, right? They can no longer make any mistake on these files. Institutions have been put out of business. Large institutions like B of A paid tens of billions of dollars in penalties for having been wrong. And whether you think it's sort of a foot fault or whether it was truly an error, you can no longer be wrong. And the best description I've heard of this is, mortgages used to be thought of as, well, we're a factory, but we're creating sweaters, right? And a sweater, every once in a while, may have a loose thread, and that's just part of creating sweaters. Now the mortgage industry is creating jet engines. People don't want anything wrong in a jet engine. Jet engines are very important that they work completely right all of the time. And so the tolerance for any form of error is just down to zero. So not only is that underwriter productivity come down, underwriters are being paid through the roof. So the origination side of the business, both because they're less productive and they're getting paid more, it's a much more expensive proposition to put out any loan, good loan, bad loan. It's true in the servicing side too. Cost of service alone is essentially tripled due to additional capacity.
So the way you
there.
don't deal with a higher cost loan is you just don't make one that's going to go bad.
Exactly. Not worth the risk.
So I had just a couple of observations on the credit box. I do think it's the credit box below 700 which is particularly tough.
Yeah.
So if your FICO 700, you can go to the FHA and get a 3.5% down loan at 120, 135 over, so mid fours rate. If you're, 10 to 20% down, 760 FICO, you're going to get sort of a GSE rate, which is the 50 bip spread. It's the people below 700 who are really having a very, very hard time in the marketplace. They're the sort of folks who have left out, and coming out of a recession, there are a lot of folks who got into trouble, got laid off, got other things, who are still trying to recover in that process. So I think in terms of the credit box, you can kind of see where that's sitting. I think, though, the capacity issue is sort of I don't want to say it's a lark, but capacity, as an economist would say, is endogenous, which is to say people choose what the capacity is, so they're choosing not to come into the market. The sort of odd thing is that choice of capacity, if you are the GSEs and you are really trying to be a profit-making monopolist, the last thing you want to do is actually have low capacity coming into you and have high profits being made by people coming in. So one of the sort of puzzles to me is why it is we haven't actually seen the GSEs go to Citi and B of A and say, look, we could use some more capacity here. We'd rather see those rates come down. And why aren't we starting to figure out how to bring you guys back in the market? And you sort of say, well, gee, all the bad things we did. Many countries and financial systems for a long time have sort of figured out this good bank, bad bank problem. It's not sort of lost, the idea that people did bad stuff in the past and we need them to operate in the market in the future. And so there are many structures that one could use to essentially segment off the set of things they did in the past and sort of work on the going forward basis and kind of bring them back in to the system responsibly, but nonetheless bring them back into the system. And I think they could be earning much more money if if they were to have more capacity, because they would be serving more people, the rate spread would diminish, and everybody would be better off. My last thing on appraisals is just for all the litigation, everybody in 2005 knew that MAI stood for Made as Instructed, especially the GSEs. So for them to be going back later and saying they just didn't understand these appraisals were bad. Look, I'm an economist sitting in my office in New York as a renter. I knew this, so did everybody in the marketplace, including everybody pricing bonds, knew precisely the appraisals weren't worth the paper they were printed on.
Lori?
Yeah, I just wanted to make one comment to follow up on a lot of these other comments, especially Mike's, and that is that, sort of we're at the point in the market where we're actually, I don't think rep and warrant risk going forward is going to end up being a huge issue. I think what we're doing is we're substituting a lot of upfront due diligence in a very rational manner for that rep and warrant risk. And furthermore, when you look at sort of rep and warrant risk historically, if you look at the recently released Freddie data that they released in terms of risk sharing, they actually broke out rep and warrant risks separately. And of the rep and warrant putbacks from 1999 to 2003, the number was a maximum of around 40 basis points of putbacks, which would have been 20 basis points of losses due to putback. So it was a very, very, very tiny number off of a actually fairly wide credit box during that period. And then you look at both what Fannie and Freddie are doing and what the private label market is doing. The private label market is doing a ton of upfront due diligence on these loans and in some cases taking fairly weak rep and warrant provisions. Similarly, Fannie and Freddie have revised their rep and warrant framework starting January 1st, where basically on loans with good history, you basically have rep and warrant risk for 3 years. On refis, you have it on cross-servicer refis, you have it for 1 year, and what they're substituting instead is upfront due diligence.
I'd like to make another point on the credit box. I think we talked about FICO and LTV. That's obviously important, but where I think you're really seeing where credit is binding is if you look by loan size, right? If we look at our purchase application data, same story in home sales, but purchase application data over the last year for loans above 729,000, purchase apps are up 57%, right? For loans below 100,000, purchase apps are down 4%. Okay, so credit is binding at the lower end of the home price scale. It's the same thing's true in home sales, so it's not an investor story for the last panel. This is an access to credit. So that's why I think that the story I was telling about, there are now much higher fixed costs to being in this business than there used to be. And so it doesn't make sense to do small loans when those fixed costs are present. This is just a true economic story. So it's another data point I wanted to throw out there.
What about because when we write about this, that it's harder to get a mortgage, people say, well, look, FHA, you can do a 3.5% down, 680 FICO, a 43% back-end debt ratio. One of the things I hear all the time from mortgage bankers and brokers is, yeah, but the income verification is terrible. So are there particular borrowers that are finding themselves with even tougher sledding because they can't prove their W-2 income, or because they had 1 year where they were out of work for 3 months?
Self-employed, you can't get a loan.
Right. Much more difficult. Yeah, I mean, self-employed, that was the original reason for a low doc loan, is someone who it was very difficult for them to prove their current income. So they're willing to pay a somewhat higher rate to not have to dig up multiple years of tax returns. Now, if they want to get a loan, they got to dig up multiple years of tax returns. In terms of the government sector, really, really important. At this point, it's roughly 30% of all purchase activity is going through FHA, VA, USDA. That's down from about 40%, right? The reason it's come down is because mortgage insurance premiums are up so extensively. You're shoving those people into the conventional market. So they're not better off. They're paying more than they would have back at prior FHA premiums. But very, very important part of the purchase market at this point.
So the last thing I want to ask on this topic is, what if we've all agreed, this is a problem, and here are the contributors? Is there anything policymakers can do about this? What levers do policymakers have if they can agree that this is an issue?
GSE reform. I mean, what else is there? I mean, FHA's pulled their levers. I mean, people talk about QM, and I really don't want to talk about it because it just makes my head hurt. But, I mean, the only way we're supposed to be talking about the future of the market, right? And we haven't even had a conversation to decide, what we want out of the future. We have a big millennial population coming up, which means FHA is going to have a big role. We've got to figure out these pieces, and we still in Washington can't decide. You got one of the biggest investors right here telling you
we lend $400 billion to homeowners.
It's a lot of money.
That's real money.
So he's telling you what he needs to invest in, at least at the levels that most people want to borrow in. If he doesn't get that, and I've been on a panel before when you said, well, then give me 30% down and you can have an ARM. And you have three of the top, housing economists, and Stan, and they're telling you if you do that, then it's going to be Eric. Sorry. So until we figure out this big giant piece in the middle that kind of takes up the mass of the bubble and come to some agreement, and it seems to most people, or to me at least, that to kind of serve the mass need and be the foundational piece of that, we know what we've got. We've got to build it within the existing structure of Fannie Mae and Freddie Mac. You got to put that guarantee somewhere to make those motors work, and we got to move forward. And I don't see how we expand, at least until rates go up. If you say we get a little more, but that's just nibbling around the edges.
Well, GSE reform is an interesting one. You cannot. So the best thing you can do from a practical point of view is not screw with the GSEs this decade. I mean, I'm a Reagan Republican from way back. I think the government should be small and they should be uninvolved. And I can't believe I'd say this, but the world ends without them at this point. The private markets cannot make mortgages.
But is that now, or is that?
Well, that's
forever?
actually even forward. So Asia won't buy ever. So where's the money come from? Asia won't buy, period. I mean, hell, Japan only buys Ginnie Maes. People like us, we're set up in a world, mutual funds, bond. We have guidelines. I mean, we can't even buy all that private stuff. I mean, forget the fact that the rating agencies suck and they're just so terrible. And that the servicers will do everything they can to steal money from everyone. And they did. I mean, that's what this whole exercise was about. No, seriously though, like the AG settlement cost them nothing. They took a $1 trillion problem, and it's going to cost them $25 or $50 billion over 15 years. They will do it again the next time. And so we're a fiduciary. We're just investing people's money, right? We're investing probably half your 401ks. And you don't want us, making stupid bets on money. Now, the private market can do it. It'll just be huge down payments. A normal person won't be able to get a loan. Housing will be lower in price and all that good stuff. There is no right answer on housing reform or policy. It's a policy question. The government has been involved for 70 years. My adult lifetime, they've only been uninvolved once, and that was the subprime non-agency thing, and it almost took out the global economy. So, people say, let's get the government back out of housing. Oh yeah, like before the Depression. Right? But that's serious, right? The government has dominated housing for 70 years because the public said, we want the American dream, and we want housing, home ownership rates to go from 45% where they were before World War II to 64%, where they stayed for a long time before they had their little brief jaunt. But the private markets cannot do this anytime soon. The question is, rates will be higher in a private framework. Down payment credit will be tougher. And it's just a question of how long it takes to transition, because homeownership rates will be lower and prices will be lower than they otherwise would have been when you get there. And it's just a question of not causing such a bump in the road that you take the economy out while you do it.
Let me take your question in a different direction and make Jason's head hurt just a bit. And also to echo what Senator Isaacson said, the QM rule could have gone in a really different direction, which would have curtailed credit substantially. It came out really pretty well. And so, commending the CFPB that you now have the vast chunk of the market in a safe harbor, in a good place with reasonable guidelines, that's going to be a good foundation to build upon. And you have to remember, that rule applies to every single loan originated in the country. The QRM is just going to be on securitized portion, and GSEs and government programs exempted. It's really important to get that right too. We think line them up because you have a very good definition with QM, line QRM up on top of it. But those two near term are going to be most important. Obviously GSE reform, very important over the medium term.
Let me actually pick up your point, and that is, I actually see GSE reform and the credit box as two somewhat separable, but not completely separable issues. The problem with making lower quality loans is they default at a higher rate, and we have to make and I see it as a pricing decision. Do you want to use average price? Do you want to use average cost pricing and subsidize, or do you want to use risk-based pricing? And what we've done is we sort of use average cost pricing to some extent and subsidize and then cut off the credit box. And we're not willing to truly risk-based price to get the lowest quality loans where you could make a mortgage, but it would be at a higher price. And actually, QM makes it harder for those kinds of loans to be made outside of agency space because of the 1.5% limit.
Yeah.
I do think there is some low-hanging fruit, and I'll follow up on some of Mike's point. You asked about the policy. Are there things to do short of GSE reform? And I sort of push a little forward your view about kind of the standardization and technology and other kinds of things. And I'll just throw out a couple of ideas. A lot of the fighting about rep and warranties should just be resolved by technology. What are the big things you're concerned about? Servicer, originators giving you loans where there's a piggyback second or some other unreported stuff. Pull a credit report on those borrowers 3 months later. And if a bunch of them suddenly have piggyback loans that show up, 3 months in, you can sort of figure out what it is. The surveillance available on credit, there are already existing products with credit reports that allow the kind of surveillance that would really quickly figure that out. If people are non-owner occupied, same thing. Credit report can very quickly figure it out. I could sort of go through and talk about appraisals, and maybe we should just be using Zestimates for this. They're free and online. There are other commercial products that cost a little more, but it's not very hard to go get an appraiser and say, if that appraisal varies from this by X amount, I'm going to go get my own person to go do the appraisal, and we know you can get within 5 or 10% on 90+% of these. So maybe maybe they should license the estimates for this, but one way or another, we could sort of deal with the appraisal issue pretty quickly. In other businesses, technology is transforming how we're doing things in really positive ways. And we've turned into this completely uninnovative kind of place where we're doing paper checking and incredibly costly things when technology could really quickly and easily solve whole set of the issues. So then we get rid of reps and warranties after a relatively short period of time, and then we've completely reduced the cost and changed the marketplace. And the last thing is, why aren't we doing real streamlined refis? Why are we still requiring anything? If the GSEs have the loan, refis are clearly gunking up capacity. We could really completely do streamlined refis in a more serious way to open up the capacity that we exist. These are all tangible things that could be done in relatively short order that are being done in many industries with existing products that are out there in the marketplace that you layer on that technology platform and standardization, and would be really easy things to do.
So
Got a really good example of that, just real quick. So just last year, the IRS approved electronic signatures on a Form 4506T, right? This is something that we've been pushing forward for years. That's the form you file with the IRS and the lender to get someone's tax return. Everybody in here uses TurboTax, right? You're allowed to file your return electronically, but you had to, the tech guys say, ink sign and then fax in a page that then the clerk ran around and got the tax return. This was until last year, right? But this is a great example, to Chris's point, of if we're going to a full doc world where everybody's income is fully verified, this is the way to do it efficiently, and we're moving in that direction. There's some other things as well.
Yeah.
So Scott brings up some good points on kind of the long-term housing finance reform piece of this, and that is what kind of support do we need if we want to maintain a 10 trillion, or what are we, nine and change $trillion mortgage market with the low-cost, prepayable 30-year fixed-rate mortgage that's the North Star of our system. And so just to play kind of devil's advocate here, because we do go to such elaborate measures, all of these government guarantees, Fannie, Freddie, to make that product available, should we rethink that, Mike or Jason? Should we, some folks will say, look, people move more often than they used to. They get married later. They divorce more often. They're paying this huge premium for a 30-year fixed-rate mortgage that they really don't use, and the government takes on all these associated risks for doing that. Should we move away to more of an ARM market where you wouldn't need as much government backstop?
No. So you actually, I mean, it's pretty clear over history that, at least from an American standpoint, that's what people want. I mean, it's just conditioned into our DNA, and it's 30 years. I mean, they started to put out 40 years and all that stuff, and people didn't want it. So, and that's fine. If that's what we want and there's a way to make it work, that's what we should have. And I know people always point to Canada and to other places that
they have high home ownership rates and no 30-year.
That's great, and rates have been coming down for 30 years, and my guess is it's not going to come down for another 30 years. So there's another side to that coin. Coincidentally, I think the last time Canada had a housing problem was probably about 30 years ago. So, that.
So you're saying we don't want interest rate risk to be in the
I'm
household
saying
sector?
you can also address it in different ways. I mean, something that just kind of blows my mind that's never talked about right now is all FHA loans are assumable. I mean, if we're a more mobile society, figure out how to make them portable. I mean, why not? I mean, you right there, at least, look, we're in a low rate environment, and that's one thing, but we're not always going to be in a low rate environment. So with a fixed or assumable or portable, you take out two of the three inherent risks for investors, which is interest rate, prepayment, and early prepayment and default. So I don't see why we're not kind of looking to those innovations to facilitate the market we want.
And I would add some kind of automatic refi provision in these mortgage. If we're going to have 30-year fixed-rate mortgages, the amount of cost that people go through every time they refinance for a transaction that creates zero value is literally swapping one thing for another.
If you do that, rates will go up, though.
Right.
But that's
Because they'll just get priced in.
No free lunch, Chris.
right. No, it's
Right,
no, but it's
Like, we'll notice, actually.
I want you to notice, but I'm concerned about the household sector. So if we sort of ask if we do 20 million refinances and everybody pays 2% of mortgage value to do them for a transaction that you could contract on a piece of paper, why are we doing that? Why are we employing loads of people, verifying, checking other things that are costing households money? And by the way, low-income minority households exercise those options much less well than well-to-do households. And refinancing is a contract that could be completely contracted on a piece of paper with zero resource costs. It is what an economist would call, it creates absolutely no value whatsoever. And what is the reason that we spend loads of resources on a transaction that could be completely contracted? And you'll pay differently.
Though if the rates go up 40 basis points or 50 basis points, the person ends up paying it, they just pay it over time.
No, but they don't pay all the costs in the middle. So you're right that you're right that the rate costs are the same, but all the costs in the middle, and there are people who have actually gone and figured out the cost of GDP. Our last refi wave in 2002, 2003, when there were 25 million mortgages written, how much did homeowners pay to do those refinancing?
By the way, I'm looking at the capital right there. You could save a lot more making the tax system easy. You know, that's where the money gets spent.
No, but just the cost of refi, how much mortgage brokers get paid, how many people are paid to do those transactions, it's a measurable portion of GDP. And when you ask why is the financial system such a high share of GDP, it's transactions that don't create a lot of value that are part of what causes the financial system to be a relatively high portion of GDP. And this is just this is low-hanging fruit, easy thing that we could fix along with transportable and portable mortgages. So why do you have to get, 6 mortgages over 30 years? Why don't you just have one mortgage, stick with it, keep the mortgage when you transfer homes, don't need to refinance it, so there's no complicated decisions. That product would save American households and homeowners an inordinate amount of money. Enormous.
So, I'm a big fan of the due on sale clause as a risk management guy. You want to know what you're lending against. But in terms of the 30-year mortgage, 87% of home buyers who are borrowing today are taking a 30-year fixed. But I think people got to recognize that American consumers are pretty smart, right? They respond to prices. And in the conforming market, it's always been predominantly fixed, predominantly 30-year. You go right above that jumbo limit, and the majority switches. Jumbo's typically been 70-30 or 60-40 ARM. It only takes about 50 basis points to flip that switch.
But they wouldn't take if the government guaranteed it and they were fixed rates, they wouldn't take that lower fixed rate if they had the option?
There's really not a difference in ARM rates between jumbo and conforming, right? Because most of those are on balance sheet. I'm saying a jumbo ARM versus a conforming ARM, there's not a big difference in rates. So we could make it a system that's expensive enough that people will jump to ARMs of their own accord. I just don't know whether that's a good outcome in an environment where rates are likely headed up. Look at the deficit, look at the debt, look what the Fed's been doing. That this is probably not the right time to be arguing for an ARM.
Now, I need to wholeheartedly agree with Jason, which we don't do that often. But the 30-year fixed rate amortizing mortgage is, I think, the perfect mortgage for Americans. We are overspenders and terrible savers. The average person looks at these mortgages as rent. They pay it every month. They don't realize they're paying principal and interest. I mean, how many of your parents, my parents, one day woke up and went, oh my God, I don't have a mortgage. Where did I get a $250,000 house from? I mean, literally, right? I bet you half the people in the room's parents did that. And people just don't realize they're saving, and one day you don't have a mortgage. And talk about where we have all these problems forward, and pension problems and retirement. It's one of the greatest forced savings plans that people don't realize they're in of all time. Especially with rates this low, because you're paying a lot of principal from the beginning.
We should touch second liens as a policy issue. No one's talked about it, but second liens that get priority over first in a variety of ways. Both the tax code and the bankruptcy code essentially subsidize taking out debt, which is not only bad from a first lien perspective, but it's also bad from a sort of national perspective if we're encouraging and making it easier for people to take money out of their home and then end in retirement worse off. So if you look at people who are in their 50s today, homeowners versus homeowners in their 60s and 70s, the people in their 50s are coming in with much more housing debt relative to their 60s and 70s, and all of us as taxpayers are going to pay the price for that, because if those folks eventually can't support that debt, they're going to be on government programs.
So before we go to Q&A, so you guys start thinking of your questions, I want to really quickly get Lori in here because Lori was on the Bipartisan Policy Commission's Housing Finance Group that came out with the proposal for GSE reform. And so briefly sketch out what the commission proposed and why you guys think it's the right plan for the moment.
Well, basically, we believe that you really do need a liquid TBA market, and to create that liquidity, you need fungibility among the securities, and you need a catastrophic government guarantee. So but we really did want it to be predominantly private capital. So what we ended up coming up with is a Ginnie Mae type structure, where essentially private capital takes the place of FHA, either through mortgage insurance or through capital markets risk-sharing transactions. And then the government takes the catastrophic risk. When we first started talking about it, and we said mortgage insurance or risk-sharing structures, and we said, I began to shudder at the thought of mortgage insurance because it has been so absolutely unsuccessful this time around. However, you could contemplate a mortgage insurance structure where the mortgage insurers are stress tested each quarter. This is the amount of capital you have to have. If you don't have that amount of capital, you're out immediately, and sort of create a much more robust mortgage insurance structure. So that was, and that absolutely has to happen. We also thought you needed some sort of a counter-cyclical backstop where if private capital is not willing to take the risk at a reasonable cost, the government steps in. And I actually wanted to mention that on the bipartisan committee, Eric Belsky served as one of the advisors, and Richard Smith was also on the committee.
Great. Maybe there'll be questions about that. We'll turn it over to Q&A. If you have a question, please ask a question. And we're going to keep it pretty short.
Yeah, my question is sort of where do you want the interest rate risk to go? Because it's sort of like everyone's backed away from credit risk. We know we don't want the taxpayers taking that. And all I've heard from you is you don't want borrowers to take the interest rate risk on mortgages. And so where do you think it'll end up? Because I'm thinking it's all going to end up with taxpayers.
Scott?
Well, I think the homeowner in the U.S. has not been conditioned to manage interest rate risk. And the way most of our money in the U.S. is set up is it's 70% interest rate risk and 30% credit risk. And so, the trained professionals, they're not always so trained if you look at what they do themselves, but at least professionals are dealing with it in a sense. I don't think the homeowner is really set up to handle it, and I think if rates go up a lot, you'll see some terrible things happen to them.
And wait a minute, interest rate risk. I mean, who's bearing the interest rate risk? It's primarily investors. The same people that bear the interest rate risk every time you sell a fixed rate government bond, which the last time I looked, most of it was. I mean, this is sort of what Scott's been doing for the last 30 years. And that's where the interest rate risk is in banks, it's in insurance companies, it's in money managers, it's guys who have been sovereign wealth funds. It's basically institutional investors who manage money on behalf of individuals who are taking this risk in corporate bonds. They're taking it in treasuries, and they're taking it in mortgages too. And it's no different in mortgages other than the prepayment variable.
One more question out there. We have time for one more question.
Yes, I have a question directly to the comments about Lori's comments about the PPC proposals, and that is, what's PIMCO's view on that?
Well, we think you have to have the government guarantee. We do not believe in MI. MI is like earthquake insurance. I live in California. If there was a tiny little earthquake at my house, they'll pay for it. But if the state of California falls into the ocean, there's no insurance company that has the money to pay for it. And that's how MI's been. It's great at handling sort of one-off little things to that house. But when we have when housing goes down 30%, there isn't an MI provider. You couldn't make them have enough capital to be able to pay it off. And so if you buy car insurance and it doesn't pay off, why do you buy car insurance? It's kind of the same thing with MI, except you got to buy MI if you're Fannie and Freddie, because that building up there said, when they made the original charter, says you have to have it if it's over 80%. But it doesn't work in catastrophic situations. The people are undercapitalized, and you cannot make them raise enough capital.
You know, just quickly, and I know we got to run. I think Senator's speaking, but you bring up an important thing, and a lot of times when we talk about this, the markets, and just they need to be 20% down, or that doesn't work. At least going forward, when we think about how we start to shape the future of the mortgage finance market, I think we really skip over and leave out an integral part of this, which is essential to the kind of ladder of everything, which is kind of the low-income and first-time home buyers. And all we always talk about is, the debt side of the equation. And I think we have a chance, whenever we do this big thing, to, kind of figure out if we want to put some of our policies or resources, if the government's going to be involved, towards savings and giving them, savings programs that can give them more choices and more equity going in and more reasons to become stable homeowners. So I would just kind of put that into the discussion.
All right.
One just quick observation, which is, I think if one looks for stability in areas in the financial system, just look for equity. I think exactly to Scott's point, the credit cards did very well in the crisis. You could continue to do credit card securitizations well into 2008. It wasn't all securitizations that died, and some autos as well. And it's because credit card securitizations had a lot of equity, and the people who originated them held the risk. And so aligning incentives and equity is always a good way to manage the risk so that you don't get in trouble even in a severe recession. And so credit card only companies actually did very well in terms of surviving. They had losses, but they weren't catastrophic in those systems. So I think that's a good model for how to think about building a system, and covered bonds in Europe look like it too.
Chris gets the last word. I'd like to thank the panel and turn it back over to Amy.